afternoon, everybody. Welcome to TraderMerlin Show for your Thursday edition, tail end of the week, and I have a surprise announcement. I guess it's not a surprise. Usually surprises are a good thing. I got called into a leadership meeting tomorrow at OTA, so I will not be able to do a Friday show for you guys. I know, oh gosh, I almost had a glass of whiskey today, but I got stuff I need to do after this, and probably wouldn't go well smelling of whiskey as I ran my errands today. So I will not be doing a show tomorrow. Sorry for everyone for that, but we'll make do for it on Monday, or make up for it on Monday. As I mentioned on yesterday's show, the Fed recently released a report that showed some very interesting data with consumer credit. And, you know, as I am building my positions, and hopefully whatever you guys decide to do with your positions, obviously should be the result of market observations, technical analysis, and maybe some fundamentals sprinkled on there. We should certainly not ignore data sets which we might not normally look at. So, for example, I don't usually look at credit, but as I step back and look at the big picture of what's going on in our markets, I'm starting to see a trend of slightly better economic data, right? You're seeing unemployment numbers increase, which is not good. You're seeing the CPI and PPI numbers start to decline, which would be good for further stimulus for our markets. You're seeing housing data slow unilaterally across the board. Everything from home builders, new construction permits, all that is starting to decline, which is in the negative column. But other pieces aren't as gloomy as they were. Retail sales numbers came out great, and some data is looking pretty good. For me, especially being in America and being part of the consumption economy, we know that we are a consumer-driven economy, and the retail sales numbers speak volumes. It says people are out there spending, which is a good thing. But if people are spending money that they don't have because they feel comfortable, they feel like, okay, no worries, I'll just buy this because I want it, then we start to put ourselves in a precarious position with regards to markets going forward. You know, we experienced this back in 2009. And how many of you knew friends or had friends or acquaintances that in 2007 and 8 were just buying all this stuff they didn't need? And you may actually be one of those people as well. There came a point where I had good friends who were buying brand new Cadillac Escalades and all this fancy jewelry, and I'm like, slow down a second here. You're pulling equity lines out against your house because you feel all warm and fuzzy. You know that this gravy train's going to come to an end, and they're no. Ended up losing their homes. So, you know, when we get that comfort mode, whether that's through our jobs, through our economy, through friends, or just our personal situation, start to spend a little bit more. So I really thought that this report was really, really good to break down. And I definitely cherry picked charts here. You can download the full report. I have it on my computer downstairs. But if you guys are interested, maybe I'll post it on my Twitter feed later. That's just the whole report. It's a PDF that's just great. It's really good. Okay, so let's start there, and then I'll dive into our current markets today. Actually, some very interesting days. I made one trade today. I actually went long on one crude oil futures contract. Yeah, I know it's kind of strange to me. I just bought the December futures contract long at $82, and we'll see. But I'll explain why I went long just one. Okay. No, I wouldn't say consumer confidence and reports matter. It's the action. So consumer confidence numbers, in my opinion, I feel that those are just overly biased because they just ask a bunch of consumers. It's what are people doing with their credit cards, right? You can say, oh, I feel really confident about the economy, but you're just not spending. To me, that's more of a statement that you're not confident about the economy because you're like, I'm not spending, I'm saving, which is what we should all be doing, right? Anyway, lecture time's over. Let's dive into my wonderful graphics. I want to thank my graphic support team. Merlin, you did a great job today. Breaking down the credit data. And of course, this is one of the very recent reports that just came out. I'll get past the economic data. So let's start off with the total debt balance and its composition. So if we look at going all the way back into 2003, and I love the way the Fed did this because you can see kind of the impacts of different market situations. If it's hard to read, or if you're watching or listening on the podcast, I've got a chart here that goes quarter by quarter all the way back to 2003, and it breaks it apart by credit segment. So obviously the largest chunk for most people is mortgages. And right now, in current quarter of Q3 of 2022, that represents about 71% of all of the debt in consumer debt in the United States. 2% of that is, I believe that's home equity revolving, so that's going to be a HELOC, like a home equity line of credit. I believe that's what the HE revolving means. Then you have auto loans, which is about 9%. I was kind of surprised to see auto loans that high. Credit card is only at 6. I really feel like credit card was going to be higher. And then student loans is this just large piece up here at the top. So the most important part for me anyway is to look at the trend. And if you look at this peak that we had back here in 2008, I kind of would have expected a bit bigger of a drawdown because so many people lost their homes and mortgages were erased. But we didn't really see that. It was a slight drawdown, but now we're at all-time highs with regards to total debt balance. So things are trending to the upside. Of course, the trend is your friend till the bend at the end is something that we always say here. However, we get to a point where enough debt is going to start to cause problems. Now, oh yeah, you're another spammer. Bye, dude. Remove, hide user from this channel. There we go. Sorry about the spam, guys. I try to get it as soon as I see them. Anyway, that's total debt balance. And what I thought was interesting is if we look at our current market, right, you go back a year ago, we were saying on this channel, like, these rates are not going to stay as low. It's historical levels. They're going to start to rise, and that's part of the reason why we're seeing that housing market bust. And as we started to see those rates increase, certainly a lot of that being tied to the 10-year. Here's your chart of the 10-year. A lot of that is what is starting to break the housing markets back, if you will. It's not allowing for new sales. People who are trying to flip houses are now all of a sudden caught holding the bag, and we'll have to wait and see what that ultimately turns into. But here is, I'm going to show you a chart of loan origination. If this market is indeed robust and this steam train keeps on trucking and we see markets make all-time highs, then you're going to need to see more loan originations for homes, for cars, etc. Are we seeing that? Well, according to the Federal Reserve, and this is from Equifax as well, you can see that loan origination has been dropping significantly. Now, this is all done by credit score. So I have pounded the table on this one many times, which is get your credit score up. OTA has a couple great videos that I did for them years ago dealing with credit score. There's some very simple things you can do to pop your credit score very, very quickly. And that does not include, going and hiring somebody to do it for you. Do it yourself. So if you're over 760, actually, if you're really over 720, you're doing great. If you're over 760, you can write your own ticket as far as credit goes. But if any of you down under 720, it gets much tougher. You're going to pay higher rates, etc. So do whatever you can to get your credit score up as high as possible. If you ever want, just ask questions, and I'll be happy to answer those on this program and how to fix it. Notice the loan origination. So if you look at the total loans originated, you had $1.2 billion worth of loans originated back in Q1 or Q2 of 2021. And now they are just declining. We're literally 50% of the loan originations 1 year later, maybe even less than a year later. So we're seeing a real sharp decline in loan originations, which to me is fuel, right? The more loans that they're making, that's more money pouring into the economy to buy houses, to buy cars, to buy whatever. That's not a good sign for the economy going forward, which made me feel comfortable holding my 80 put positions today, even though it was a choppy market. So that was another great chart for you guys from the Fed report. But I guess when you look at the loan origination, that just means people starting off. I think the real question is, for the people out there that have loans, what are they doing with them? Like, how are they positioned? I talked very condescendingly, like, okay, who in the right mind is going to have an adjustable rate mortgage when rates are going to go up? Bill Addis and I 2 years ago, might have been 2.5 or 3 years ago, we're saying, look, the odds of rates going lower, extremely small. The odds of rates going much higher, extremely high. Why? Because we're so low. You're not going to go negative. And, if you were an adjustable rate mortgage at that point, you have to have switched out, right? And saw the writing on the wall, flipped out, got into a fixed one, just knowing it's not going to go lower. I read some crazy story about people who are still in adjustable rate mortgages, and I just wonder, what's wrong with you? I mean, how could you be that ignorant to yields and interest rates? What's going on with you? Certainly, those people are going to be defaulting if they can switch, they'll switch. If not, they'll default. So here's a list of defaults. This actually is encouraging, right? Because you look here, this is on mortgages, those who are severely derogatory, meaning over 120 days, there's 90 days late, etc. So it actually looks fairly decent. Now, the only weird part here is I do see one that's severely derogatory. It looks like the total number is staying the same, which is right around 2.5% to 3% of total mortgages are in a delinquent state. Some are severely, and you notice that slice of this green here, I think it's green, is starting to get a little bit higher, meaning more are very late with their payments over 120 days, which that's going to lead to foreclosure. So this green area here could lead to foreclosures. But the good news is you do have this like really clear downtrending line for late payments. Most of it seems to be under control. So that's a great sign. Ultimately, we might see that start to spike back up, but right now it's looking good. Now, here's where we start to break down credit and see what's happening. And I thought that this was interesting because this is the transition into delinquency in the last 30 days. Very interesting. So you can see you've got your home equity line of credit, mortgages, credit cards, auto loans, and student loans. Now, in 2021, or starting in 2020, student loans just fell off the cliff. I mean, it went from, it looks like 10% of the balance all the way down to about 1%. So looking really good. But notice what's happening on the hard red edge. Literally the last 2 quarters, maybe 3 quarters, we've seen all of them except student loan debt, have sharp increases back up and showing that now we're starting to see more delinquencies. Now, again, that does not mean that this is the end. It just means that there's a sign that the market might be flipping here and more people are in a position, maybe through unemployment, maybe getting new low-paying jobs where they're not making as much money, and all of a sudden they find themselves 30 days late, which is not that big of a deal being 30 days, but it will ding your credit score. Make sure you get that one. So, thought that was an interesting chart here. Let me real quick. I got a question. If you have some, let me know. Are they still at OTA site? So they are. I believe they're on OT Academy. I did like 6 or 8 videos, but I think they only have 2 of those up there. I know a lot of it came down when we did compliance, but I would definitely encourage everybody here, or anybody, if you guys want, I'm happy to do a show on credit. I actually have an idea for a show, which I'm hoping that my friend will do it, and it's one of the most valuable lessons I've learned. It's basically how to travel around the world for free. And my friend does some very interesting tricks, we'll say, with credit cards where he doesn't actually ever buy anything, and every year he gets at least one first-class ticket anywhere in the world without actually spending money on his credit card. So I'm hoping, I'm trying to get him on the program right now to talk about that, but maybe I have to do it with a voice changer and remain anonymous, and because he doesn't want people to know it's him. Anyway, yes, so a couple of them are still on that site. Let's see. GS says, still amazes me how much regular people don't know anything about markets, interest, yield, etc. You know, you're right, GS, and I think that we suffer in this country from a huge deficiency in financial literacy. You know, you're always told to save. You're always told to invest. But at surface level, saving and investing, well, what? What percentage? How do I do it, right? I mean, to me, there's a lot more behind it. And I think that part of what I love and why I'm still with Online Trading Academy is the need and desire to develop financial literacy and empower people to take control of their own investments. Historically, in the Leave It to Beaver era, this was a man's world. Right? This is a man thing. Women, you stay in the kitchen, you cook me a sandwich, you make me dinner, and you change the baby's diapers and clean the house, but I'm doing the finances. And that's archaic. That's stupid, right? Everybody should be empowered to do their own thing. And now we have 2-income households, and honestly, I love seeing so many women, especially on this channel, take control of your finances. You know, if you're a married couple, you should absolutely have a say in what goes on with those numbers because ultimately it's your nest egg combined. So, yeah, definitely need a vacation. Actually, my friend is actually in right now in Thailand, traveling around with free tickets. So, all right, I'll work more on. I'll push him to come on. He's going to be very resistant. Isn't the lack of student loan delinquency due to a hold on required payment? Yes, I believe so. I believe that period, especially because when COVID hit, they went on that little period of lock, and that may be part of the reason why we saw this drop here in transitions on late mortgage payments as well. But now all of a sudden we're coming out of it. So, you know, if you look at, let's say we draw some lines here. let's just draw lines. I'll do it on, where's credit card debt? Let's do it right here. Actually, no, let's do it on mortgages because mortgages there was a moratorium on some mortgages. So let's say right there, right? That's where the mortgages peaked in 2020, right as COVID hit, right? Where I got this little cross, okay? Well, you notice mortgages right now are still much lower. When right before COVID hit, we had looks to be about 3.75% delinquency on mortgages. Now we're just at 2%. But the important part for me anyway is this. Notice that we're trending up. It's clear that for 3-4 quarters, we're trending up. And now the acceleration, I'm wondering if it starts to look like what we saw back here in 2006 and 7, right? We saw a slow curl up to here, right? Guys, look at 2005 and 2006, early 2007 off to the left-hand side. And then all of a sudden, it went real steep, right? That once that snowball gets moving, it can pile up real quick. So I thought that was interesting. And, do we end up seeing this? Well, I think you would all agree that if we see that, then our markets are going to get headed down in a pretty big way. Pretty big. But we'll have to wait and see. The mortgages is interesting because that's obviously a big ticket item. But I really am interested to see what happens with this credit card debt. Credit card debt is the ultimate killer. You can be delinquent on a home mortgage, at 3% or something, but all of a sudden you find yourself with $10,000 worth of credit card debt paying 22 or 23% interest. You're buried. You'll never get out from underneath that without help. So, if we see more people do that, and I'll show you some charts here in a second, we could find ourselves in some very precarious financial positions. Now, this one isn't such an important one with regards to credit. I just thought it was kind of interesting looking at who's taking out credit. So, as typical, you generally see, those 18 to 29 not really increasing too much, right? They're not that big of a consumer. We are seeing increases in that 30 to 39 category, and fairly sharp increases, I would say. All these charts are from the Federal Reserve. So the Federal Reserve issued a report on consumer credit, and they partnered with Equifax to get this one. But you can download it from the Fed site if you want. Like I say, I'll run downstairs after the show today, grab it, and I'll bring it and maybe put it on my Twitter feed if I can, so you can download it from Twitter, which is at TraderMerlin. So there you go. Almost all these are from the Fed report directly. I picked a couple others that I thought were interesting, which we'll see in here in just a second. So total debt by age, no big deal here. I actually kind of thought that those were over 70. I mean, this is kind of surprising to me that you are seeing those over 70. They're getting bigger as far as the percentage of debt that they're owning. You notice back here in 2003, 2004, 2005, those over 70 had almost no debt. Really, it's like very small. And all of a sudden, that seems to be the one that's increasing the most, and also the 60 to 69 era. And maybe, that's due to, I'm not quite sure why that would be. Maybe your retirement account's dropped and you're trying to do a gap funding there by using credit cards, etc. But kind of interesting to see that the older ones are actually starting to increase their debt much more, whereas the 40 to 49 and the 50 to 59 seems to be fairly constant. All right, what else we got? So here we go by type. Not much has really changed here. This was just kind of to see what's going on by generation, but I don't think that this gives us any idea of trends. I just like to look at this because what are people buying? Those who are over 70, not much in the way of cars. The youngsters, obviously cars and a little bit of mortgages. Could it be due to more reverse mortgage loans? Possibly. That could definitely be a factor in it. Yep. Unfortunately, the colorblind. I'm kind of colorblind to this, but can't really see too much. See this top right here, student loans. So the two student loans were possibly due to inflation and minimum increase in Social Security. Possibly as well, right? Not keeping up with the cost of living. Inflation's getting too high. Maybe, and then again, that's just something that's just a trend. And if we can spot trends, then that might lead to another action or reaction by the financial market. So let me go to one that might be more telling here. This was as of credit cards. So specifically on credit card debt, not mortgages. We looked at mortgages earlier. And if you look by breakdown, it's interesting to see the sharp spike. And the sharpest curve up, not surprisingly, in credit card debt balances or credit card balances is on the younger group, 18 to 29. But all of them are curling up. And you guys all know my belief. My belief is that you should have nothing on your credit cards. You should have zero balances. You should pay them in full every month, but you should use your credit cards for every single thing you do. Make every purchase with a credit card, rack up points or hotel miles or whatever you want. There's all these perk cards. You could use something like the Discover card, which will give you 5% cash back. 5% savings right there. It's like a giant coupon that keeps on giving. Why wouldn't you use that, right? Those of you who use ATM cards or debit cards, I kind of don't get it. It always boggles my mind. People go, well, I know that if I use a debit card, that my money's there. I can only pull out what I have in my bank. Well, just practice some fiscal responsibility and go, okay, I got $500 in my savings account. I can't go over that, right? That's all mental stuff that you should be on top of because it is your money. The point I make there, if you're using a debit card and someone happens to guess your PIN number and starts pulling money out, you may not get that money back. Right? I know you can, but it's a process. It's not as easy as a credit card. Whereas if somebody steals my credit card, racks up $3,000 worth of sales in 5 minutes at stores all over the world, I'll call my credit card company. Someone's got my credit card that was all stolen, taken care of. That $3,000 is credited back to my account. I have nothing to worry about. So it's safer to be using credit cards. Plus, I get to gain all the perks out there of whatever credit card it is. And I've done sessions on that before where I target specific credit cards. I have a calendar, a Google Calendar, that I am constantly mapping out when I need to cancel a card, and then I'll look at new ones to reopen and get the bonus perks. But we could do a whole show on that another time. You can tell I get excited about credit. So that was kind of interesting to see the credit curling up there as far as consumption, and this is transition to serious delinquent 90 days. And again, those are starting to surge. Past 90 days obviously is devastating to your credit report. Now, let's take a stab at the dark. Where do you guys suspect is the highest amount of debt in the U.S.? Like if we look at by state, right? You know, most people are going to go, oh, well, Wyoming, nobody's using credit cards there. And you probably point the finger at California and be like, man, those Californians, everything's expensive in California, right? So where do you think the most expensive one? New York would probably be fairly high as well. Just kind of guessing out there. Curious what you guys think, because our next chart shows exactly that. Let's go look at that one. And, you know, this also, here's the chart of where the balances are going. Dave says, I went from a credit score of 300 to 790 in a few years just using credit cards and never... Exactly, man. Congratulations. Honestly, 300, Dave? Wow, you were like that's a vagrant credit score. Like if someone sees if you went and applied for an apartment and someone pulled your credit report and you had a 300, they may not even call you back to say, I'm sorry. That's just like, dude, get away. We want nothing to do with someone with a 300 credit score. I had a friend of mine that had like a 510 credit score, and we got him up to over 700. It was awesome. Really happy to see that. So good. Congratulations. That's a lot of work. And that's one thing that you did it by using credit cards. People feel credit cards hurt your credit score. It does not. Just make sure you have you don't carry any balances. And if you don't trust yourself, then just use a $500, tell them to put a $500 credit card limit on you so you don't go past that. But it's all about trust and understand the system. Yeah, I bet they did, Dave. I mean this in the nicest way, Dave. I'm laughing at you. I don't think I've ever heard of anybody with that low of a score. That is, wow, low. All right, so yes, you're right. California leads the way. You can see the amount of debt here, which is total debt balance per capita, is massive. It's basically saying that Californians have on average about $83,000 worth of debt, whereas on the low end here, I'm not exactly sure what this low end one is. Maybe that's Ohio. Looks to be about $42,000, $43,000. Now, the reason I like these charts going back into the financial crisis of 2008 is we can see how quickly they declined and then they've slowly built up. And I'm a big believer of waves. We kind of have not really seen a wave to the upside yet. If these markets do, in fact, stay inflationary and we go into a recession, expect these lines to all accelerate to the upside, kind of like they did back here in Q3, Q4, Q5, or 2004 and 5 when they surged to the upside. So that one, I love that chart. That one's kind of interesting. All right. So all of it so far doesn't paint the rosiest picture. It looks to me like from a credit situation, credit's necessary for expansion of the economy. To get it to grow, to get it to build, we need credit, which is the primary reason why the Federal Reserve has said banks do not need to hold any of your deposits, not one penny. They can lend it all out. That's fractional reserve banking. Now, of course, that's what got FTX in trouble, but at least the banks are insured. If we start to see more financial issues and the Fed really need to slow down the economy, they're going to start to raise the reserve requirements. And that means less loans for the banks, and that starts to slow down the economy. If the economy puts it in a position that I think we're headed in, which is higher unemployment, lower wages, and more layoffs coming, then these charts should all start to see more steep incline progress towards higher numbers of debt. Why? Because there's going to be a stopgap that people are going to have to fill. They're going to have to find ways to pay their mortgages, pay their kids' school, food, etc., your gym memberships, all that stuff, with no job or lower paying jobs. And we'll have to wait and see if that all plays out. That's kind of what I think is coming. But given the last two inflation numbers and retail sales this week, it all looked pretty dang decent. Nothing over the top. Now, there are a couple pieces, since I'm such a stickler for making sure you have no credit card balance in any cards, what does that look like for Americans? And I saw this one. This is really kind of cool. This is this chart here says of all the credit card accounts in the first quarter of 2022. So this is a little bit lagging, but notice I'm actually really surprised. 41% said that they carried a balance at some point. 36% said they used the card but never carried a balance. That would be me. I'm in that 36. And then the orange slice there is had a card but didn't use it. I have one card that I don't use at all. And just as a credit lesson, the card I don't use at all is a Wells Fargo card that I opened up when I was 18 years old. Now, for anybody in here, you understand that a large part of this is about your credit card history, how long you've had credit. And from all the industry experts I talked to, if I were to close out that Wells Fargo credit card that I got when I was 18, it's going to distort my credit past. Because I no longer have that card, they'll look up my next most recent card and say, oh, well, there's your credit history, which to me sounds stupid, but it's a way to benchmark your credit history. So if you have an old card that you don't use, just look in your wallet and say, this is the oldest one I have. Don't get rid of that one. Don't close it. So this was pretty good. Then the next slide shows us of all those cards, how many were carrying a balance. And I'm really surprised to see this. Used the card but didn't carry a balance, 46%. That is that's a really good number. But it also means there's a lot more potential for people to use credit and find themselves in a bad situation. So I'm almost done. I know I'm going over. Eyes are probably spinning. You're like, just show me some charts of the market. Last couple charts here and then we'll wrap it up. Here is percentage of credit card accounts that are 30 days delinquent, 2024 to current market. And again, I just brought this one on here to emphasize the curl. You're starting to see that curl at the bottom moving back to the upside. Not that that means anything like a huge surge. It's just we've bottomed out there and logically it's going to start to move back up. How high it goes is really important, right? If we see a spike like we did in 2007 and 8, I think we're in real trouble. But so far, not that bad of a picture. It's just, is this the warning sign of a bigger move up or just a natural correction off the lows? Because let's be honest, there's always going to be some people that are delinquent on their credit cards, always. And the last one, total outstanding credit card balances. Even though we're seeing very few people in default, it seems like we have more than ever the highest number of credit card debt ever recorded, according to the Federal Reserve. We just hit it. We're over 900, I think it's 928 or $924 billion worth of credit card debt. And, well, that looks like the trend is your friend, and it's surging to the upside. So we could see a print here probably in the next couple quarters of over $1 trillion worth of credit card debt. And the higher that goes, in my opinion, the more stress that puts on consumers to keep their head above water. It could be pretty ugly. Anyway, there is way more charts than we probably ever looked at as far as fundamentals and macro picture. Take it for what it's worth. I just thought you might be interested in that as we look at housing, we look at CPI, PPI, GDP numbers, unemployment data. This is one I don't normally look at, but I think it's telling right now that we're in the transition, right? We're in that period of time where all of a sudden we're starting to see people default. There's starting to be some increases in there, and I think it paints a picture for some rough patches for credit cards and debt going forward, especially with the mortgage market raising so quickly. All right, what do we got? Opening card doesn't hurt much. Nope. It'll actually give a couple point ding on your credit score. I didn't close any card. I used 2 cards. Each was due 15 days apart. I used one for bills, the other for all goods. I pay each one. Yep. And then the other thing there that I would encourage anybody with a credit card is 2 things. Number 1, for every credit card that you open, I would encourage you to download the app on your phone, and you can go into the settings on that app, and you can make it where anytime there's a charge, for me it has to be an amount, so I put 1 penny. So anytime my cards are used for 1 penny or more, it automatically sends me a message. And sometimes I get results back to my phone before I get approval at the point of sale machine. And what that does is it just allows me to know what's going on with my credit card. And if there's a charge that I don't recognize, I'm on the phone to the credit card company right away. So that's number 1. The other thing I would say is you should always set up for auto pay. If you know you might not be able to make the full payment every month, you should, at a minimum, on every single account you have with a credit card, have it signed up to pay the minimum. Just in case you forget to mail it, you don't have a stamp to send the check, make sure that you set it up to auto pay at the minimum. I think you should auto pay the whole balance, and that's good financial management to keep you, I guess, under the line of your spending habits, right? You know I can only spend X amount of dollars, great. I won't exceed that with my credit card. I was only asking about opening and closing accounts frequently. I use my cards exactly as Merlin. So if you open and close all the time, it will ding your credit score. But remember, if you open a credit card, it'll ding it, 5, 6 points, not that big of a deal. If you close your credit card, it'll usually drop more. And the reason for that is you have on that credit card a specific credit limit. Now, when let's say you have a $20,000 credit limit on that card, as soon as you close that card, your entire overall credit limit will decline by $20,000. And that may be a problem, especially if you're carrying balances on another card, because that could put you over certain percentage thresholds of your usable credit. And then that could really ding your credit score. So actually opening credit cards can help your credit score, believe it or not, because now you have more money to spend. And as long as you're not spending it, credit card company says, hey, this guy's credit worthy or girl's credit worthy. We'll go from there. I get emails, don't need apps to set. Cool, there you go. I like it on my phone. I just like to see when it happens right away. But, to each their own. It's just using automation and technology to make things better for you. All right, let's look at what happened out there today. Yes, let's look at what happened. So let's start things off with our economic and earnings calendar. Earnings, there's very few things that continually surprise me in the financial markets. I got to say, Macy's is one of them. I just don't get how Macy's had such a huge run. And look at their earnings. Macy's here was expecting 19 cents profit, came out at 52 cents profit. They beat by 173% and therefore had a big surge on the day. But as you run down this list, notice everybody today beat. And we had a nice gap down in the markets to start, right? Ross Stores beat, Kohl's, Palo Alto Networks, Macy's, Applied Materials, Alibaba. Just victory across the board. And you might remember back here when we had this chart right there and Macy's up at $37, I'm going, I don't get it. If I had more chutzpah, I probably would have shorted Macy's. I did not, but just didn't make sense that, going back into the pandemic when businesses were essentially closed, all of a sudden you had Macy's just surging. Just really shocking to me that Macy's did so well. Well, here they are today reporting earnings and had a real nice pop up on Macy's. Most of the other companies out there did well. Remember, we had retail sales numbers better than expected yesterday. So here's Ross Stores. They also beat earnings, are up 12% on the day. Right now it's actually up, it's at 113. So I'll show you the after hours here real quick. Let's go to 15 minutes, and there you can see the after hours. Ross Stores just absolutely surging to the upside, and then there was Macy's, but Macy's did theirs before market open, so a little bit different. ROST. Now, as far as Ross goes, I'll bring a horizontal line right here. I'm one that loves when I get huge earnings jumps like this. If it jumps up into an aggressive supply level, I may be looking at shorting it. And if you look at where it's at, that's this dashed line across the top here. Technically, if it opens up right tomorrow at 113, I may be looking at shorting this bad boy. And it seems crazy to go against something that had blowout earnings. I mean, they were expecting to make 81 cents. They came out $1 profit, 23% surprise on earnings. But you're right up here to the supply level. You actually blew through two of them. I'd be interested in potentially shorting this one tomorrow, but we'll have to wait and see how my morning progresses. I got a bunch of stuff to do in the morning. And then what do we got? Economic. Yeah. The whole economic data, some of it was good, some was bad. There was housing data that came out today. You can see right there, you had your building permits and housing starts. Interesting to see that we were declining on building permits, right? Went from 156 to 153. Well, even though it's a decline, it's not a decline as much as expected. They were expecting 151. So that was better than expected. And the same thing here for housing starts. But I think the bottom line is you're seeing a slowdown. You're seeing these things drop. Building permits, housing starts, and that could seriously start to impact the housing market going forward. Again, 1 point data, we'll wait and see what that trend shows us. Unemployment is still ridiculously low with unemployment claims at 222,000, which was also lower than expectations. And other than that, the only thing that was really noteworthy for me was up here at the top. You can see final consumer price index numbers coming out for the euro. Surprisingly to me, actually showing a decline. I was expecting it to come out higher than the 10.7. Uh-oh, you lose me? My mic's going. I'm still good. I should be good. I should be. John Todd said he lost me. I think I'm here. I'm not showing any drops, so I'm going to pretend like I'm still here. But anyway, given the fact that the EU has been so late in raising rates, right? It took them forever. U.S. was raising already. Australia, Canada, the U.K. was already raising rates, and the Euro is just like with their hands behind their back going, no, we're not doing it, we're not doing it, we're not doing it. And all of a sudden they started to raise aggressively. So I actually thought that we would see a bit of a problem for the CPI number for the Euro. Really came out better than expected. So that was a shocker. Don't think that's going to help them with their rate increases. They'll probably still keep raising their rates, but at least inflation looks to be somewhat in check. As we saw with the UK, it wasn't so good yesterday. So that's it. That's my calendar for today. We'll run through our markets here in just a second. Let me get to... All right. So how much time do I got left? We're on a random long... Oh, well, plenty of time. What am I looking at a clock for? All right, let's look at what's happened out there in the equity markets, commodity markets, cryptocurrency markets. As I mentioned, I bought one crude oil's December futures contract. That's the CLZ 2022. And main reason for that is, we had this ascending triangle up to right here. It looked good. And all of a sudden I'm like, no. It broke outside the trend line and I'm feeling bearish on it. However, it came screaming down today and actually finished the day down almost 5%, 4.9% slide for crude oil. But it did so right at this little area of demand. Now, it's not strong. It actually goes back to October 22nd was the first test or retest of this demand zone. It's a tight one. I'll have to monitor this tomorrow and see if I decide to hold it for a while, but that one just put one contract on, so I don't really have much money on the line there. Merlin, you reckon if Twitter runs into some serious issues, Tesla stock will suffer? I don't know. I really don't know. I'm kind of curious what happens with Tesla because you guys know I do have Tesla share. I have puts on Tesla. I sold puts on Tesla that are going to close at 180. So I may get executed tomorrow. I'm actually loving the way this is happening because I have Tesla puts at 180. I've got SLV puts at 1950. And I love this move today. I really hope that tomorrow we close at 1949 and I can sell all these calls against my position. But those are the two I have. And then I have GLD. And I have the 165.50, so I'm already now below my strike price for GLD. So good. I'd love to hold my gold. I like to hold my silver and sell call options higher above it. But as far as impacting Tesla, I don't know. You would think that there would be some relationship there, and unfortunately we can't track the price of Twitter anymore because the chart just doesn't exist. It's gone private. But I would think there would be some pain there. It seems to me like Twitter right now is just a shit show. It's just a total mess. And I'd love to think that Elon Musk is going to clean that up, but I wouldn't. If Twitter was publicly traded right now, I wouldn't look at buying Twitter. I would maybe be even looking at shorting it. But I think Twitter could potentially get in much more trouble. It'll probably go down in history as one of the most overpaid transactions ever. Well, it didn't. I mean, it didn't shift over. I'm still seeing plenty of volume on the CLZ. I don't plan on holding it for a long time, just so you know. This was designed to be a short-term trade. I actually am really, it may end up being a day trade on that CLZ. So let's go here, There's your 2022. I mean, this may just be, I might be out by tomorrow. I really want to see what happens if we get a bounce from here. So I really did not plan to hold this one a long time. So yeah, maybe volume is rolling off into that one right now. No, we're going to go for that March contract. All right, well, either way, it's still plenty of volume. There's still plenty of liquidity, even though it starts to roll in. But it shouldn't be really rolling over for another week or so. But yeah, I didn't pay attention to that one. Let's see. Tom says Tesla won't be a media darling anymore. Price should go down to normal auto company valuations. I tend to agree with that, which is kind of why I'm hoping I get out of my. I'm hoping that my puts expire worthless tomorrow. There you go. F23 would be the next one. Correct. Moving up. Let's go up that list. So we had crude oil. We had Russell 2000. And there were some crazy swings in here. There were some crazy swings in the Russell and the NASDAQ and S&P today. It was looking really good for a while, and I was loving my short position. And then all of a sudden, we had these real quick jerks to the upside. All in all, we finished down because of the big gap down that happened overnight. You were at negative 0.82% slide in the Russell 2000, bring it to 1842. Crude oil and gold and pretty much everything except Bitcoin was down on the day. But here is your gold chart. Get that volume out of there. There There you go. So gold slowly rolling over, which I'm okay with. Again, I want it to close below, I want GLD to close below 165.50, which we did today. And we'll see what if we hesitate there tomorrow. But we had a slight rollover in gold, and maybe that has something to do with the increase in the dollar, which is up 0.38%. If you look at the S&P, which I have puts on today, really bummed to see as much as it rallied off the lows. It was doing great for a while there intraday. Thought about closing it out. I'm like, no, I'll carry this one a little bit further. I do think that in the next week we'll probably see more continued slow sell-off here, but I could be totally wrong. We were down 0.33% on that S&P. 39.55 is where it finally closed at. Index-wise, you got two more to go. That's the Dow, which was down 0.03, although that's just the brand new rollover period. It was down more than that. Now that I'm getting the numbers rolled over, so there you go. So, it's just slightly down, 0.03, 33,581. NASDAQ, same picture, right? All of them had the long bottoming tail today as there was some nice end-of-day surge in price. And then the last one on here is going to be Bitcoin. B to the T to the C. And I am in the camp of more pain and downside move coming for Bitcoin and other cryptocurrencies. Part of the Crypto Investor Live program we did this morning was looking at the balance sheet of FTX and just understanding how Sam Bankman-Fried was so entwined in so many companies. I mean, it's really kind of crazy how he was just entrenched in so many businesses, companies, politicians, and the damage that may have, especially if they start to liquidate their portfolio. So gut tells me that when those come to market, you're going to see a lot of other stuff here drop even sharper. Now, one other piece which I was kind of fascinated about, you guys might remember Bill Addis and I had that discussion on the 10 versus the 2. And in normal markets, people would say that's the yield curve, right? Yield curve is the 10 and the 2, the 10 years subtract the 2 from it. And that difference reflects the inverted or not. And the blue line I have here is showing, the green line is 0, and the blue line doesn't need to be there. Right now you're at 0.69, which is 70%, 0.7%, so 70 basis points. You could get more for just buying a 2-year. But really, Bill goes, that's not the true yield curve. The true yield curve would be the 10 and the 1. And look at this. I mean, this thing is just tanking right now. You can almost get a full percentage point more yield for holding a 1-year bond versus the 10-year. I'm kind of fascinated by this, and it's interesting to see because in my mind, it feels like it's accelerating, right? We talk about the trend is your friend to the bend at the end. Well, it was hesitating. Right here, I was like, okay, it's stalling out. It looks good. And then all of a sudden, we broke those lows, just like a normal trend break or breakthrough demand zone, and we're seeing a further steepening. Now, I think what this tells us, at least for me, is this puts more pressure on the Fed to slow down rate increases, because the more that the Fed keeps raising that short end of the yield curve, the more that this is going to invert. And to me, that gets rather problematic. Now, if we look at the FOMC numbers, they really haven't changed much, but I think that will start to become a talk track by a lot of the talking. Ooh, we actually jumped back up today. Remember, yesterday was 85% chance of a 50 basis point increase. Now it's 80. So that shifted a little bit, moving back up to almost a 20% chance of a 75 basis. That's interesting. Did not see that coming. But I think that the general consensus would be if this keeps getting more and more inverted, it'll put the pressure on the Fed to slow down their rate increases. Right now, you'll probably get 50 at the December meeting, maybe 50 at the I think it's in the February meeting. But we'll have to wait and see what those all come out to be. But the picture is really ugly. And if we go here to, let's say, monthly, and I go to the 10 and the 2, the reason I bring this one up is, notice going all the way back into the 80s, we've never had this steep of an inverted yield curve, right? You guys can see down here at the bottom, we're currently at right around 0.7, negative 0.7. We've never been there. Even in the savings and loan crisis back here in the late 80s, you were at 0.448 negative. If you go back to 2000, you were at 0.51. Even the financial crisis only got us down to about 0.2 negative, and here we are at almost 0.7 on the same thing. So this is getting a stronger reading of inversion than anything in recorded history, at least on these charts that I can see. So that to me continues to paint a rather ugly picture for the markets, and I don't know the solution. I just know that the more that this happens, the more pressure that puts on these markets to the downside, which is why I'm got a pretty decent short position. I'll probably keep on building that unless I get stopped out by a market rip to the upside. So there you go. Any other questions? See, Merlin, I was in the strategic investor class, but heard you speaking of rates going up and other countries. Are you going to load up on long-term? You talking about puts? Yes. I don't know if I'm going to get to. I don't know if I'm going to get to the levels I was back in 2020. All right, I had 420 puts on. That was much. I'm at 80 now. You know, if I get to 150 or 200, that'll probably be fine. But I think it's more about letting the market dictate. You know, I don't want to force something to happen, which I kind of did in 2020. I pushed a little bit too hard. Obviously, I would love to have had 420 puts on in this most recent sell-off, but I didn't. It's fine. So, you know, back in 2020 when I made that trade, and some of you may not remember, but you might be new here, but I was building a position based off of what I thought would be a double dip. And I thought that after we bounced initially, I may as well look at the chart here and go, let's say the SPY or ES, we'll go daily. I should do it weekly. So if you look back here into 2020, when we had this, I was really expecting it to have a bounce. And then right in here, I expected it to drop down. And I was just loading up big time on put options. And unfortunately, stopped me out. Ended up being, you know, like a $65,000 loss, which obviously was painful. But I was really swinging for the fences because I thought what we would get is just to bounce up, come to supply, and then make new lows. Because it just did not see us getting out of this situation as quickly as people expected. But, you know, when you pour in $17 trillion into the market, you know, shame on me for thinking that the market would not react favorably. And this is the result of it, guys. I was just looking at some charts the other day of M1 money supply, and you know the reason that this happened is because $17 trillion poured into the market. M1. So here's M1 money supply, and just so you can see that chart, this is exactly why those markets roared. I mean, and this goes all the way back to the 1950s, guys. I mean, it's just insane that we went from $4 trillion of money in circulation to $21 trillion in just 2 years. So if we zoom in just a hair here, you can see now what's the Fed doing? They're unwinding their balance sheet, right? They made that announcement this year, and you can see they're slowly starting to unwind and remove money supply. That's good because that's going to hopefully fight inflation here, but unfortunately, I was heavily short during this pop right here, and yeah, that one ended up being a big loss. But I will continue to build a position if the market does continue to drift down. At this point, you know, I'm a little wary about the most recent pop we had. The reaction to CPI number and PPI were pretty pronounced, even though I don't think we're out of the woods. We're higher than I thought we would go, but I'm still going to leave these blue lines on here and see if we get those going forward. Good question, or good comment, Lisa. I will build more put positions, correct, directionally, and mainly on market bounces, right? When you get a nice bounce, I'll look to be buying some puts and play directionally. Okay, I think that is going to do it for me for today. As I mentioned, I'm not doing anything, no show tomorrow. Sorry, everybody. I will have a nice glass of whiskey tomorrow night in honor of all of you. So I hope you have a great, Lisa, it's not a loss, it's a lesson, right? It really was not that big of a deal. I mean, it was money, but it wasn't money that I needed to survive with, right? That's what you should never do, is trade that. So I went in, I knew I had a maximum stop loss of $75,000 on the trade, and I ended up losing $65,000. So it was $10,000 off my absolute rock bottom, but it's okay. No big deal. You know, nobody likes to lose, but it's also one of those pieces that you learn from it. And bottom line is, when you see that much money pouring into the market, you should immediately just start buying everything you can. I remember talking to Big Ed about doing intervention on in my put options. You did. No, it's okay. Tom, remember, it was all part of a plan. I had a plan in place, and I said, by this date, if you know, I'm going to exit my put options on this date, and I did. I exited on that date and took a loss. No big deal. That was my plan. Anyway. All right, everybody, thank you so much. Hope you enjoyed today's show. If you have questions, comments, feedback, whatever, let me know. You can put them down below the YouTube videos, any one of those. I see I've got a bunch of comments there, so thank you guys for the comments. You can always email me at TraderMerlin@gmail.com. And then on Monday, if you have a topic or something you want to cover, let me know. I'm going to have John Rowland on the program on Tuesday, so I'm excited to have him back on. He works for barchart.com, and just one of my commodity experts and just a great trader and good friend. So I'll have John Rowland on the program on Tuesday, and maybe some other surprises later on in the week. But if you have some, and obviously Thursday, Friday, don't expect shows next week either because it's Thanksgiving. It's crazy to think that Thanksgiving is like right there around the corner. So it's going to be a light week or so, but I will see everybody here on Monday. Have a great trading session tomorrow. I hope you make a bunch of green, and I'll see you on Monday. Take care, everyone.